Hello and thank you for joining us. I'm Rikke Eckhoff of Unquote. The topic today is accountancy principles and fair value. In short, fair value is the market price of an asset if you were to sell it today. It was incorporated into the private equity industry in 2005 by the European Trade Associations to apply with US GAAP. But for private equity, with mostly unlisted and often illiquid assets, it remains a very difficult valuation system. And with the financial crisis, transactions came to a halt, exit markets were effectively closed, mark-to-market valuations became near impossible. To help us detangle the issue and hopefully bring some clarity, I have with me Nick Rea of PricewaterhouseCoopers. Thank you very much for joining us, Nick.
Pleasure.
And how did the financial crisis affect the fair value debate in private equity?
Well, I think in your introduction you talked about fair value being a concept that tries to understand what would you get if you sold an asset today. And that's been a very difficult concept for some people to understand, particularly if you have no intention of actually selling today. So that's the first point that people find very difficult. So it is a hypothetical concept in as much as you have to try and assess how much you would get for an asset. Now, that's been extremely difficult, as you suggested, in the last year, and I think it remains extremely difficult for 2009. The reason it's particularly difficult, and I've said this many times, is valuation is subjective. And that means you need to apply judgment. But you need as many data sources as you can to help you. And the difficulty that we're having at the moment is that there are very few transactions in the market. So that's often a really good source of information. The second point is, as you noted, we've had the crisis and really high volatility in markets. That means that public markets have shot up, in recent months, having had a massive decline before. So how do you take into account when there's so much volatility? Makes life very difficult for us. I mean, just the last thing that plays in this was the other thing you mentioned was accounting standards. So there's been a lot more guidance provided by the accounting setters, both the US GAAP and IFRS. And that means that people need to understand all the accounting rules as well. So that there's a hell of a lot going on at the moment.
And the International Private Equity Evaluations Board, they recently updated their guidelines, and PwC is due to publish comments on that. What are your main concerns with the updates?
Yeah, they have issued their updated guidelines. They issued them in September. We are going to publish this very shortly in the next 2 weeks. The reason we wanted to issue this was this gives the PwC view of those updated changes. And whereas there are some things that I think are very helpful, so in terms of fair value, you can't hold things at cost anymore for the first 12 months, and because that doesn't really equal fair value, although a lot of private equity houses like to do that. You can't do that anymore, so after a few months you've got to start properly fair valuing investments. The other updated change which makes a big difference is the thing called the marketability discount. Now this takes account of the fact that you've got to actually take time and effort to actually sell or exit a company. So you can't just take a price from, say, a public company and apply that. You need to apply an extra discount. And what the updated guidelines say is you don't just knock it off at the end. You don't do a 10% or 20% or 30% adjustment, which you used to do. Now you really have to think about what would you sell that company at? What sort of EBITDA multiple or earnings multiple you would actually sell at?
And when you're out talking to clients, how does private equity houses react to these new guidelines?
Well, I mean, there's mixed reaction, to be honest with you. I mean, I think a lot of people acknowledge that when they're buying companies, they think about multiples. They think about we're buying this at a 7 multiple or a 9 multiple. So in terms of private equity language for deal makers, this must make sense, because what you're doing is saying you bought in at this multiple and we would sell at this multiple. So at a purely commercial level, I think there's a lot of sense in what's happening. The downside of it, I guess, is that I don't want to get too technical, but what you're actually doing is you're applying a discount at both debt and equity level by doing it in the multiple. And technically, from a technical point of view, that isn't 100% right. So, as I say, I like it from a commercial point of view, but then you start getting into some of the technical issues.
And for investors, the LPs, I mean, IPEV set out to make things less complicated for them and to help them in their valuations. How do they solve that?
I mean, I think this should help comparability, because, I mean, and this is a journey I think that everybody's on. So investors are getting more and more demanding. They're not just asking at year end for information on value and more information, but I think they're asking for it throughout the year. So what I think this will help is investors can get into the multiple language and say, look, what sort of multiples are you now driving at for your exit, for your fair values effectively. And they can start to do more detailed comparisons, I think. So again, and the IPEV board, when they released this, they did say this was all in the spirit of comparability and consistency with accounting standards. So the guidance that's being issued is meant to be heading in that direction. I just think, as with all changes, it just takes time to bed in.
But I mean, even with all these extensive guidelines, it remains sort of a very subjective measurement. I mean, it seems doomed to be forever complicated.
I mean, I think you're dead right. It is subjective, and again, as I said at the start, there's always subjectivity in valuation. For as long as I've been doing this, there's always been subjectivity, and there always will be. So I don't think we should worry too much about that. You know, with many things, many judgments people need to take, you need to apply your own views, and we have no problem with that as a firm. What we like to see is that there's been a proper consideration of what the fair value is, because if you cut away all the technical stuff, what you're trying to arrive at is a true view on what you would sell this company as. And what we've seen some private equity houses do really well is think about, right, get their finance people together with their front office people, so the deal makers who are in the market who understand this, and have a proper debate about what this company would go for. And then make sure there's a really good sense of challenge and understanding between those groups, which is then properly documented and signed off by the board or evaluation committee. And then you have real feeling that, you know, this private equity house has taken this very seriously. And then when we come along as auditors, or some of the other, you know, the other Big Four or other auditors, we would look at that and think, no, yes, they've really thought long and hard about this internally. And that gives us a lot more comfort that the proper process has gone through.
So fair value is essentially trying to give a realistic picture of sort of the market and their assets today.
I mean, it absolutely is. That, as I say, if you cut away all the other accounting standards and everything else, that is what these updated guidelines are driving at. That's the challenge for private equity houses, and nobody's pretending it's easy. And I would never say there's a right answer, but there are a range of reasonable outcomes, and I think as long as people try and get within that range, that's the best that people can do at the moment.
Thank you very much. That was Nick Rea of PricewaterhouseCoopers. I'm Rikke Eckhoff of Unquote. Don't forget to check our website, www.unquote.com, and I'll see you soon.